All right, thank you all for attending this month's Silverstone Financial Monthly Market Update webinar. This month is September 2022. We will be starting with disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk unless otherwise stated are not guaranteed. Please be sure to first consult with a qualified professional advisor and remember that past performance is not indicative of future results. You can see my website for additional disclosures, and throughout the webinar, please use the Q&A button at the bottom to submit any questions you may have. A quick bio. My name is Jeremy Eppley. I'm a chartered retirement planning counselor, accredited portfolio management advisor, and accredited investment fiduciary. You can learn more about my experience and qualifications on my LinkedIn page. And Silverstone Financial, the firm, is a fee-only fiduciary registered investment advisor. We specialize in wealth management and financial planning. In a few months, we're looking to launching some tax prep work. So look out for that announcement. I'll be talking about it more in a future upcoming webinar. And you can learn more about our firm at our website /about us. There have been some updates to the website. So anyone that wants to learn more about our services or our pricing or anything about that, please check it out. So hopping right into the notable events of last month of August, it was a somewhat uneventful month. There are two major things that happened that I wanted to discuss. There was no Fed rate hike announcement this month. September is one of the months that you don't, or August is one of the months you don't get a rate hike announcement. And it was a benefit to the market because it gave the Federal Reserve 2 months of inflation data and economic data that comes out every single month to make a better informed decision about whether they should tighten more or slow down on their tightening or stop. So this month, September, we'll be getting their rate hike announcement, and I'll discuss that more in a future slide. But because of that, the market didn't have that many big events to grasp onto, or specific big events that were pushing the market in one way or another that could easily be pointed to, okay, that is causing this move or that is causing that move. There's a lot of what I was seeing, a lot of professional advisors and professional investment managers looking at their strategies and looking at their expectations and recalibrating and making sure they are where they want to be for the coming of the end of this year and the beginning of next year. So there was kind of some reordering in the markets, and I'll show you a graph in a bit, but you'll see like a spike up and then a drawback down, and it kind of shows that people got a little bit ahead of themselves, and there was that, again, recalibration is the word I like to use, where they came back and they were solidifying what their positions want to be for the end of the year, but pre-positioning for that end of year shareholder accountability. So the first big event that happened was, of course, Joe Biden signing executive action, doing some federal student loan forgiveness. It was $10,000 for those making less than $125,000 per year, or $250,000 for married couples. And for those that had a Pell Grant, they could have a total of $20,000, so an additional $10,000. And for those of you that don't know, a Pell Grant is awarded to students that meet exceptional financial needs, so lower income students. So they would be receiving some more aid there through the forgiveness. Of course, it's a political issue, so I won't be making comments if it's good or bad, but it definitely will be helping quite a few younger people that have this big burden of student debt to get farther along in their economic lives and maybe be able to purchase a house earlier and such. But at the same time, it will likely be contributing to our inflation problem. It's essentially a $10,000 stimulus check for some people. Of course, it's spread out over, it would have been paid over many years, but it's still additional stimulus or additional financial easing, as we would say, which could hurt the markets by having unintentional consequence of giving people more money to spend and therefore having more inflation. But we'll see. We'll talk more about what's been happening with inflation in a bit, but it's been moderating a bit, which is very good to see. Now, the other very big event that happened was the Jackson Hole Economic Symposium. It's an annual event that the Federal Reserve has, and they bring in academics and economists and the Federal Reserve presidents and such, and they talk, and they eventually make a kind of like a keynote announcement. Fun backstory. I'm not an expert on it, but I had read about it at one point. Paul Volcker, I believe, or at least ex-Fed President Volcker, needed to attend these meetings, but he didn't want to attend the meetings. So they decided to go to Jackson Hole, Wyoming, where it's a beautiful resort area, essentially, and there's great fly fishing. Apparently, he was a big fly fishing person that enjoyed that stuff. So the very, somewhat, I would argue, extravagant place of Jackson Hole is a very nice, essentially, vacation area. They're having a very, most people consider boring economic symposium in one of the most beautiful places in the earth. So very, just side note, fun story there. There's some history there that is interesting to look into. But talking about present day, Jerome Powell and the other Fed presidents were seen by many commentators as being more hawkish than they were in August. So for those of you that haven't heard of the term hawkish versus dovish, hawkish commentators or market watchers are those that are more afraid of inflation and are in favor of the Federal Reserve or other entities tamping down strongly on inflation. So for the Federal Reserve, it'd be quantitative tightening and raising rates. And in July, why there was a big market run-up, which I'll show in a little bit, was because Jerome Powell came off as dovish in his announcement, saying, we're not going to crush the economy and such. And, you don't need to worry too much about markets. There was a lot of, subtle context clues that these commentators and analysts look at. So, you got to take everything with a grain of salt. But this time, a month later, he seemed more hawkish, having more of a commitment to beating inflation. And that is a fear of the market of they'll over tighten and they'll cause us to go into a deep recession. So we'll see what happens there. Overall, I'm feeling pretty neutral. I think they're on the right path, and a much better path than last year, denying that inflation was a thing and then basically falling behind where they should have been. And we will see the true impact it'll all have. It may cause, if this hawkish tone that was seen by the commentators is true, and he is really going to crush inflation as his number one goal, then we could see more rate hikes than we had initially anticipated, and them going on into 2023, and that could really hurt the economy. So I've been watching that, and we'll definitely talk more about that in a future slide and future webinars, since it changes month to month. Notable risks. There's no real new notable risks from last month, the same 5 that I see. However, I would say that one is definitely improving. So a lot of our inflation concerns are ameliorating. Just yesterday, I believe, it was the 27th inflation or economic report that had come out for this month. And 26 out of the 27 reports were below expectations for inflationary activity. So that means the expectations were already to be better than the month before, and 27 of those indicators beat expectations. So it's showing that these rate hikes, the anticipation of more rate hikes, the quantitative tightening, and just supply chain and other issues that you see here, the global conflict, the COVID-19 pandemic, just global supply chain issues with shipping. A lot of that has been really improving behind the scenes, and we're starting to see that in these pricing indexes and these indicators that make us feel a little bit better about the markets. So if anything, I would say these notable risks have improved from last month, even though that you'll see in a couple of slides, this market was red for the month. And so although the market is down, I would say we're probably in a better position than we were. So quick recap of what you're seeing here for those of you who haven't seen it before is a heat map. The larger the icon, the larger the company, the redder it is, the more it lost, the greener it is, the more it gained. This is how I look at the markets every single day. And it's broken up by sectors, and you'll see that energy, of course, has still been the big winner of this year. I'll show you what it did this month, but was very interesting to see was that crude oil was down, but the energy stocks were up, which likely shows of some anticipation that crude oil has become oversold, and we might see a bump in oil prices going toward the end of the year, but I'll show you that in a future slide. So year to date, S&P 500 is down 17% versus the global ex-US stocks are down 20%, so beating it by a little bit. However, most Americans have their money in mega cap stocks, which is down almost 20%. So the S&P 500, at the top 50 of those, mostly big tech names, have dragged on a lot of people's performance. And this month was no exception. I'll show you in a couple slides, but NVIDIA and such, NVIDIA and Tesla were big losers because of certain company-specific risks that they held on to. And Bitcoin, gold, all these alternatives have also been falling. So a recap, just to remind what July looked like. July was very green. That was that market bottom, the bottom in June, and a lot of all the stocks that we had fears about that, oh, are there demand, is the revenue going to fall because demand is going to fall because we're going to fall into recession? A lot of that skepticism left the markets. So there was a big rally in July. And what I see is this month wasn't to do with the economy or the position of our expectations becoming worse. It was becoming better. However, we kind of, I believe the expression is, we got over our skis. We went a little bit too fast, and this is just a correction. It's all right. We overbought, so let's get back down to a reasonable level. This next slide. This is what I had shown you last month with BlackRock and the S&P 500 and how it looked in my expectations, saying that this likely was a bottom and this was a good run up, and we'll probably see a little bit more, but I can't see too much more. Now, fast forward a month, this additional part right here was August. So it traded flat for a few days, then it ran up, and then right around here was Jackson Hole, where we had the Fed talk, and some of these expectations or more fears coming to the market have fallen down. If you see for the quality, it's subtle and it's hard to tell, especially on a graph that's small, but I had said quality is probably where you want to be, and it ran up slightly more than the S&P relative, and then it gave up slightly less of those gains. So what that tells us is there's a, not resizing, resizing is when you change the sizing of your positions, but it's a re-quality, or I'm not sure the perfect term to describe it, but people are upcycling their portfolios into higher quality stocks. The stocks that are maybe a little more value oriented, but mostly just have impeccable balance sheets, have great leadership. The speculative stocks have fallen out of favor and have fallen more and dragged on a lot of the performance of the rest of the market. So I continue to have that opinion. Value is a slightly more attractive currently than growth, but most importantly, quality stocks are the best places to have assets. And for this month, this was what happened. As I had mentioned a few slides ago, what's really interesting was energy was the best performing sector. However, crude oil fell 10%. So you don't see that very often. Usually it's they're correlated very, very directly. Likely what that's telling me is two things. One is that oil is seen as more of a safe haven than the rest of the market. And two, that crude oil, the actual asset, the commodity, is being mispriced, and that the stock market is expecting crude oil to increase. What's interesting also is every single one of these indicators is down. And they're all negative. Usually gold, again, is correlated to the market, versus this entire year, gold has been not a great investment. Gold has done basically nothing to negative slightly. And this month, again, gold was not seen as a store of value. Bitcoin was not seen as a store of value. A lot of these other commodities have not seen a store of value. But the driving indicator, what is driving that move is because inflation is coming down. So gold and such is inverse to the market, but in a more real way, it is correlated stronger to inflation. It's a commodity. So inflation is when commodity prices and prices of services go up. So if inflation is falling down, then the commodity prices should be falling. So that's what gold is doing. So we're in a really interesting spot where the market is down and commodities are also falling, which is kind of showing me a interesting scenario where, again, we're in a metamorphosis where we're going from a market that inflation was taking control of and the markets were falling because of that, to, okay, inflation is getting under control, these commodity prices are getting to a better place. And I'm thinking in the future, this will definitely be helpful and will lead to a healthier market in 2023, 2024, at least optimistically. So I want to revisit the question quickly about, did we hit a market bottom? So I made a case for it last month, and I'm going to stick by that case. I believe that we did. This is the S&P 500, and we had almost hit 3,600 as the bottom. It's slightly above it, and about 3,700. And I expect that we may retest down to 3,600. More likely retesting down at 3,800. Again, remember the economic picture has improved. So I wouldn't see it dipping down lower than the very big fears in June. So it wouldn't be surprising to me if we traded flat for a little bit or traded down or had a slight bump up and then continued down to around 3,800. And that's probably where we'd be bottoming for a second bottom. And then it would be just trading in this range for a while until the end of the year. So if you can see, this 4,200 is this interesting resistance point back in June. And again, here it has this head over the shoulders. This is a resistance point. Over in mid-August, we kind of got over our heels, as I had said, and we sold off pretty quickly after that. So I wouldn't be surprised until the end of the year that our trading range is between 3,800 and 4,200, and we're going to trade flat and volatile, which is never a fun thing to tell your clients, is you're going to have this wild ride that you don't want to be on. You're not really going to make much out of it. However, stick with it. 2023, if they don't over tighten and if scenarios don't get worse, like a war broke out or inflation became more of a problem than expected, or there were some sort of major supply chain issues or problems with manufacturing, which is a lot of ifs, but if those don't occur, 2023 could be a very good year. Not as good as 2021. 2021 was a very extremely good year, which was one of the reasons why this year is is worse because we basically were having a version of this where we got over our heels in 2021 or got over our skis in 2021. And now we're giving back a lot of that and getting back to a healthier, more reasonable valuation. And that all has to do with raising rates. When you talk about like the financial technicals and how stocks and equities and bonds and everything is priced, you see that since rates are rising, all the past investments have to be repriced to present value. And the new present investments that are available, the new bonds, are being sold for higher rates. So you can make more investing now than what you had. So everything has to come down. So because of these rising rates, everything has been acting, in my opinion, very rational. It's not an unrational market, which is good to see. Unrational markets are the ones that are dangerous. When you talk to an advisor and you ask them, why is this happening? And they say, I don't know. Versus here, it's rational. And I like seeing how this market has been behaving, even though we're down for the year and this month we're down. We're in a better position than we were, and I'm optimistic for the future. This is the last slide, just a quick reminder about the future Fed expectations for the rest of the year. So August doesn't have a meeting. Instead, it had that Jackson Hole event, a conference, and it gives the Federal Reserve both August and September data to make an informed decision about the September rate hike. Now, it's expected between 50 or 75. 75 would be a more hawkish tone, 50 would be a more dovish tone. And there are a lot of commentators on both sides saying, okay, do 75, front load it, and then wait. And then there are others are saying, do 75, and then if you need to do more, do 50 or do 25, and do as much as you need until inflation is under control, because that's the number one fear, is letting it get out of hand. And there are others that are saying, well, just do 50 and wait and see what's happening, because we want to make sure that these rate hikes are needed, because we're already seeing a lot of these reversals in the indicators for inflation showing that it might be under control. So my personal expectation, if you had asked me last month, if you have seen this, it said 100 basis points more, which is what was projected. Versus now with a more hawkish tone, I wouldn't be surprised if it was 100 or more. So 100 or 125 more basis points of hiking. If I had to guess, we're probably going to get 75 this month, unless the remaining indicators that will come out in the coming weeks are very good. Then maybe they'll take a step back and only do 50. I wouldn't be surprised if we did 75 this month, and then 25 for the rest of the year, where it goes to 125, and we'll see in 2023. There was a big expectation, which is why the market sold off, that, oh, in 2023, they're going to cut rates and it'll be great. And then we'll go from back to 3 instead of 350, and then it'll stay at 3 for a while. However, the Federal Reserve President, Jerome Powell, kind of put that to bed and was like, we're going to stick with a plan for a while. And so if they're going to put it to 3.5% or 4%, they're going to probably leave it there for a while. They're not going to immediately reverse course, which is what a lot of commentators and analysts and economists expected, which is why there was that sell-off. And if they're going to leave it for a specific point for a while and see what happens at that rate hike, or at that interest rate level, we will be in worse position if they over tighten, because say the correct level is 350, but they go to 4 to be safe, and they leave it at 4 for a very long time. That could be very dangerous, being overly tightened and causing a recession. Versus what the expectation was, if we're going to get to 350, we're going to maybe go to 4, and then you'll cut it back down to 3 or something like that. And everyone's going to be great, and the stock market is going to flourish because of that. So we're going to have to see what the rest of the year will bring. We should be, I believe, in September, getting an updated dot plot from them, which will shed a lot of light into the expectations of 2022, 2023. And September is probably going to be a much more impactful month to the markets, rather than this month. Not much happened, and it was just kind of like consolidation. So unfortunately, I can't have a more entertaining recap, since not much happened. But when not much happens in the market, that's usually a good sign. So I hope you enjoyed that presentation. I have at least one question that I'd like to address. If any of you guys have any additional questions, please put them in the Q&A section now. So the question I have is, do you think the midterm elections will affect the market? I definitely think they'll affect the market, but I don't think that they should affect the market. So that's going back to, I had mentioned, like, I like markets that act rationally, which most investment managers would say. Time and time again, there's been a lot of studies, and there are studies on both sides that will contradict the majority of the studies that I would agree with, that neither party is particularly bad for the market. There is no strong correlation to this party is better than this party. The best scenario for the stock market, I'm not saying for the country or for the world or any other scenario, but for the stock market, historically, it is when Washington is in gridlock, when the presidency and the Congress are held by different parties, so nothing can get done. And that's simply because of the fact that businesses thrive when everything is predictable, when they can predict that there is no new law that's going to come that's going to change the competitive edge of their business, or is going to, allow tax credits for this new competitor, and they're going to eat into some of the margins. And they can project forward and be able to make better and more targeted and slightly riskier, but since they have a lot of information, investments, which return more assets and more dividends to their shareholders. So they will definitely affect the midterms. I won't go into my predictions on who would take what seats, because I'm not a politician or a political analyst, but I wouldn't be surprised if there's, in the coming months, a lot of commentators, especially like CNBC and CNN and Fox, and they're going to be talking all about how it's all going to affect the market. I would say, don't worry about it. Focus on holding long term, and usually the political landscape doesn't affect, or at least doesn't affect it in a way that can be predicted. It doesn't affect the market that way. So I guess we'll hope for gridlock if you're team shareholders, and we'll hope for your political party if you're slanted in one way or another very strongly. So that's my only question for tonight. It was great having you all, and I hope you got some good out of it. And I hope to see you guys all again next month. See ya.